Thank you very much. It's very good to see so many people here. I like to think that we've perhaps got everyone in the UK who's interested in this topic here in the room today. And if they're not here in the room, they're probably watching online, particularly considering everything else that's going on in UK politics at the moment. And I'm very glad to be surrounded by my people and with shared interests. And this is a topic that just fascinates me. And in that post-Brexit, one of the key areas of differentiation for the UK vis-a-vis its past membership of the European Union has been its free trade agreement agenda and what it is willing to do in order to get those free trade agreements and what commitments it is willing to include. If we think about the recent ones, so the Japan agreement, which both rolled over and improved, particularly in the digital space, upon the EU agreement that preceded it, but also the new agreements with New Zealand and Australia and the digital economy agreement with Singapore, we can see that the UK has shown a willingness to move beyond past approaches to digital trade and place itself at the forefront of international best practice. So when the City of London Corporation approached me and said, well, would you like to work with us on a report focusing specifically on this issue and whether these new agreements had been beneficial to the UK's financial services sector and where they could be improved, I leapt at the opportunity, and it's been an absolute pleasure working with Duncan, Tareem and Alex at the City of London to deliver this, and also my colleague Catherine, who I did promise I would mention due to the sheer amount of work that she put into this. But this question of whether these agreements deliver commercially for the UK's financial services sector is actually quite a big one, and it's also not particularly easy to answer. But before I delve directly into that, I just want to provide some context. And we've already heard this already, so I'm not going to labour the point, but barriers to digital trade are on the rise. And my view is that actually as more economic activity shifts into the virtual space, more government intervention is near inevitable. I mean, at the soft end, you can think about hybrid working and some of the issues that raises for financial regulators, but then you can also take it to the extreme end of a metaverse, full virtual reality style scenario. How do you police the sale of financial-like assets in that context when you have multiple regulatory jurisdictions underlaying it? And the answer is the government and regulators are going to do something. The question is what they do and how they go about doing it. And if we look at, these are the OECD figures, we can see that they found that there's 92 explicit data localization requirements in 39 countries. If you stretch your definition of data localization to take into account more implicit data localization measures, such as, for example, censorship or arduous content moderation rules that require people in country on site in order to react within, say, a 12-hour period, that number grows. The Information Technology and Innovation Foundation, and particularly a researcher called Nigel Corey, has found that when you look at direct and indirect measures, data localization measures, they've more than doubled since 2017, and there's now around 144 observed in 62 countries. And the point I would make is that 40 of these measures explicitly target financial, tax and accounting data. But then there's another issue. What do we even mean by digital trade? And this sounds like a silly question, but you often get sort of, to put it bluntly, politicians and like saying, we've done all these great things on digital trade. And you say, well, what do you mean? Because there's even confusion between digital trade and the digitalization of trade. Some people stand up and say, digital trade is great. We're going to turn all of these documents that were once paper and put them online. That is excellent. That's not actually what I'm talking about here. That's what I would refer to as the digitalization of trade rather than digital trade. What I'm talking about in terms of barriers are behind-the-border regulatory measures that force companies to store and process data on local computer servers. I'm talking about efforts to apply duties to cross-border data transmissions, and I'm talking about efforts to condition market access on the sharing of proprietary information, such as source code. And to give some examples, one that sort of everyone would expect maybe, and one that everyone might think slightly more strange. If you're a financial services provider operating in India, the Securities and Exchange Board requires financial institutions to store critical data within India. If you're thinking about payment services operating in India, you have to store copies of that data within India, even if the transactions happen outside of the jurisdiction. But even in the US, to return to it, we can see in June the US Senate reintroduced a data export control bill that, if it came into force, would regulate the sale and transfer of US personal data to high-risk foreign countries. This is national security, perhaps legitimate use, but it is a restriction on the ability of companies, and particularly financial services companies, to operate cross-border. So the question of, do the UK FTAs help? It depends how you go about assessing them. If the question is, do UK free trade agreements create new market access opportunities for digital services providers, and in this context, financial services providers operating in those countries? The answer is no. It's nearly impossible to find an example in the Japan agreement, the Singapore agreement, or the Australia or New Zealand agreement of new market access being created. But that's because I'm asking the wrong question. Because that's not what those FTAs are intended to do. That's not what the Digital Economy Agreement with Singapore intends to do. What they are trying to do is lock in existing practice, lock in the current scenario, which in the case of all of these countries, whereby market access for financial services providers is not conditioned on storing and processing the data locally. So the question as to effectiveness is actually, do they succeed in doing this? Do they succeed in binding these countries to existing levels of market access? And do they constrain politicians, regulators, policymakers from further interventions that would actually make market access, the transfer of data, more difficult in future? And here, it's not easy to answer, because these commitments in the trade agreements come heavily caveated. We will not require you to store financial data on local computers or data servers unless. And they also come with really large caveats. And Australia is quite instructive on this, in that UK, Australia, open markets, both very committed to the free flow of data. But if you are setting up in Australia as a financial services provider, it is easier to do so if you store your data on a local cloud server. It's not impossible to store it elsewhere, but it's easier. And this speaks to cost. And we're talking there about two of the most publicly open countries and the challenges you face there. But when we think about the big exceptions, they are national security. All free trade agreements come heavily caveated on with national security exceptions, and as I think everyone would argue, rightfully so. But it does lead to interesting outcomes. Mexico, party to the USMCA. We've sort of heard from Dan earlier about how the US's progression on financial services data in the context of free trade agreements has evolved over time. The USMCA has some excellent provisions on paper. But Mexico is requiring fintechs to store their data on local cloud servers on the basis of national security. Okay, maybe they can argue the case. But it's interesting in that the USMCA hasn't prevented that from happening. You've then got the prudential carve-out. This exists in the WTO context. It feeds through into trade agreements. This allows financial regulators to breach trade obligations in the event there is concerns about financial stability. Again, okay, I think we'd all agree that's correct. That should be the case. But how do they go about it? And then you have public policy. And here's where I'm going to give a UK example. Public policy incorporates privacy. And if we think about GDPR, which in the context of the financial services sector, when you're talking about personal data and financial data do overlap. They're not, they don't always, but they do intertwine. And if we think about, for example, anti-money laundering regulation, know your customer rules, actually you end up with de facto data localization obligations unless you're dealing with jurisdictions that have adequacy arrangements or you put in place standard contractual clauses. So while the UK does not condition market access on financial data being stored locally, it does have rules alongside that create similar sorts of conditions. And these are justified in the context of these free trade agreements by the public policy carve-outs. So my point here is that the FTA themselves, the language is great. The UK really is at the forefront of this in terms of what it is willing to commit to. But politicians, policymakers and regulators still retain a huge amount of wriggle room when it comes to deciding how these are implemented in practice and what rules are followed and which are ignored for various number of justifications. And of course, many of these are legitimate. But one point I would make is that the fact that China believes it is able to accede to the CPTPP and accede to the Digital Economy Partnership Agreement on the basis of the text that's there, two agreements that have some of the most forward-looking financial services and data, not financial services and data provision, but data provisions more broadly. The Digital Economy Partnership Agreement skips financial services a little bit. But the fact that it thinks it's able to commit to those and join, perhaps with some tweaks, should give us pause for thought, in that we are not talking about a country that is historically willing and on the liberal side when it comes to data transmissions. So this is where we get to the conclusion, and this is where I'm just going to wrap up with the recommendations from the report. The UK is in a really good space on this. It's shown willingness. It really is at the forefront. But of course, when it comes to delivery, I do think improvements can be made. First, and this was mentioned in the first panel, regulate about buy-in. There needs to be skin in the game. They need to be involved with the mandate setting, the negotiation, and then with the delivery. Because if the regulator is on board, then there's going to be more chance of these rules being effective and beneficial to the companies they regulate. The second point is to build out regulatory processes and dialogues around concrete commitments. So you don't require financial data to be localized unless what? Be specific. And one of the things I would like to see is a regulator-to-regulator MOUs that require both parties to commit to a shared understanding of what constitutes a legitimate reason to onshore data. And I'm not sure this will happen, but I think it should. I'd also like to see a requirement to identify, list and justify all pre-existing regulatory measures that breach the commitments of a free trade agreement. That sort of transparency would be much welcome. Thirdly, I'd like to see a formal mechanism for firms to be able to escalate complaints. So if there is an on-paper breach of the obligations of a free trade agreement, firms should be able to raise that with the regulators, and it should lead to dialogue and an attempt to resolve the issue in a way that does not require data localization or new restrictions. And fourth, data adequacy. I mean, personal data, financial data is intertwined. You sort of need both. And as per the recent ISRG report, the best solution here would be global, a set of mutually acceptable principles that allows personal data to flow freely across borders, given certain conditions are met. But that's a longer-term solution. So in the interim, it is the UK working out which countries it can enter into adequacy agreements with and quickly. And that is, of course, quite high up the government agenda, or at least I assume it still is, given the slight change in government. But I'm confident it will be. These proposals are fairly modest, I would say. I mean, it's very easy to walk into a room and just say, well, we should just allow data to flow freely. Ignore but I do believe they're realistic, and they are things that could be operated on and would make a commercial difference for the companies involved and increase the effectiveness of UK free trade agreements. But I'm going to close there.